The Canada Revenue Agency has already issued tax assessments to Canadian TFSA holders, whose accounts it has classified as carrying on a business of trading securities. The assessments are not calculated as capital gains. They are calculated as 100% fully taxable business income. Every dollar the account earned, taxed at the highest marginal rate, with compound interest running daily from the year the income was generated. And because TFSAs do not file annual tax returns, there is no limitation period protecting you. The CRA can reach back to any year your account was active. Any year your trading history looks more like a business than a savings account. Any year your balance grew in a way that passive investment returns cannot explain. If your TFSA balance is over $100,000 and you have been actively trading inside it, you need to watch this video before the letter arrives. Welcome back to Canada Property Watch. In part 1 of this series, we exposed how the CRA denies the principal residence exemption when your use of your home raises questions. In part 2, we showed you how the agency reaches back into transactions from 3 years ago using the normal reassessment window before it expires. In part 3, we exposed the adjusted cost base audit and the receipt trap waiting for every Canadian who paid a contractor in cash during the renovation boom. Today, in part 4, we are going somewhere that most Canadians never expected this investigation to reach. We are going inside the tax-free savings account. We are going to show you exactly how the CRA is reclassifying TFSA investment income as fully taxable business income. What behavior triggers the audit selection? What the legal consequences look like when the assessment arrives, and why the account the federal government introduced in 2009 and marketed as permanently tax-free is becoming the account it is now examining most aggressively in 2026, because the words tax-free have always had limits, and the CRA is now enforcing those limits with a reach and a precision that the original design of the account never led Canadians to expect. To understand why this is happening now and why the enforcement is escalating in 2026, you have to understand the original intention behind the tax-free savings account and how that intention has been systematically exceeded by the way a significant number of Canadians have actually used the account. The TFSA was introduced in January 2009 as a general-purpose savings vehicle for Canadian residents. The concept was designed to be straightforward and accessible. Canadians contribute after-tax money into the account up to an annual contribution limit that has varied between $5,000 and $10,000 per year since the account's inception. The money grows inside the account through investments. All income earned inside the account, whether from interest, dividends, or capital appreciation, is completely sheltered from tax while it remains in the account and when it is withdrawn. There is no tax on the way in, no tax on the growth, and no tax on the way out. For the Canadian who puts their emergency fund into a high-interest savings account inside a TFSA, or who holds a diversified index fund for decades as a supplement to their retirement savings, the account works exactly as described. The tax shelter is genuine and it is permanent. The problem is that this is not how everyone has used the account, and the Canada Revenue Agency has the trading records to prove it. Let us build the profile of the person at the center of this investigation. Let us call him Kevin. Kevin is a 44-year-old software developer living in North Vancouver. He has been investing since his mid-20s, and he considers himself sophisticated about financial markets. In 2020, during the pandemic, Kevin started actively trading inside his TFSA. He had time. The markets were volatile in ways he found readable. Opportunities seemed obvious to him in a way they had not seen before. He bought and sold technology stocks during earnings cycles. He traded energy stocks based on commodity price movements. He bought options contracts on index funds when he anticipated short-term volatility. He participated in junior mining company financing rounds. He executed trades frequently, sometimes multiple times in a single week, sometimes on multiple days consecutively. He spent 2 to 3 hours every evening studying charts, reading earnings reports, analyzing sector data, and monitoring his positions. His account was not a passive savings vehicle. It was an active operation that consumed a meaningful portion of his intellectual and professional energy. By the end of 2021, when Kevin had turned a TFSA balance of $48,000 into $231,000. A gain of $183,000 inside an account he had been told was completely and permanently protected from tax. He felt vindicated. He felt like the system was working exactly as it was supposed to work. He withdrew $60,000 to use toward a down payment on an investment property in Coquitlam. He left the remaining balance in the account to continue compounding. He told his colleagues about his results. A few of them opened their own TFSAs and asked him which stocks he was watching. In February 2026, Kevin received a letter from the Canada Revenue Agency. It was not a routine information request. It was not a compliance review notice asking general questions. It was a formal notice of assessment for the 2021 tax year, issued under the CRA's authority to assess tax that was never reported, because TFSAs do not file annual returns and the income was never disclosed. The assessment stated that based on a review of Kevin's TFSA trading activity for the 2021 calendar year, the Canada Revenue Agency had determined that Kevin was carrying on a business of trading securities inside his tax-free savings account. Under Section 146.2(6) of the Income Tax Act, income earned from a business carried on by a TFSA is not exempt from tax. The $183,000 Kevin earned inside his TFSA in 2021 was being assessed in full as taxable business income, not as capital gains taxed at 50% inclusion, as business income taxed at 100%. At Kevin's combined federal and British Columbia provincial marginal rate, the tax on that amount exceeded $94,000. Compound interest accrued daily from the 2021 tax year added $18,000 to the total liability. Kevin's bill was $112,000 on an account the government had told him was tax-free. The $60,000 he withdrew for the Coquitlam property down payment was already embedded in that investment. It was not sitting in a savings account waiting for a reassessment notice. It was not liquid. It was not accessible in any time frame that would allow him to respond to a government payment demand within the normal collection process. Kevin could not write a check for $112,000. His TFSA balance at the time of the assessment was approximately $190,000, but accessing it to pay the assessment would create additional tax consequences depending on how the account was subsequently treated. The CRA registered a lien against his primary residence to secure the assessed debt. The account that was supposed to accelerate his family's path to financial stability had become the mechanism through which his family's primary asset was encumbered by a federal government debt he had no capacity to immediately discharge. Now, let us address the legal framework that makes Kevin's situation not just a cautionary story, but an increasingly documented pattern of CRA enforcement that is escalating in volume and in the size of individual assessments heading into 2026. Under Section 146.2(6) of the Income Tax Act, a TFSA that carries on one or more businesses is liable to pay tax under Part 1 of the Act on the income derived from those businesses. The legislation does not define what constitutes carrying on a business inside a registered account. That determination is made by the Canada Revenue Agency on a facts and circumstances basis, applying a set of criteria the agency has articulated in its audit guidance and that the Tax Court of Canada has affirmed in decisions that have progressively strengthened the agency's legal position. The criteria the CRA uses to determine whether a TFSA is carrying on a business are drawn from the factors historically applied to distinguish business income from capital gains in the general income tax context and set out in CRA Interpretation Bulletin IT 479R. The first and most significant factor is the frequency of transactions. A high volume of trades, particularly where individual positions are held for very short periods of time, is the most direct indicator that the account is operating as a trading business rather than an investment vehicle. The CRA has not published a specific annual transaction threshold that automatically triggers a review. but legal practitioners working in this area have noted that dozens of trades per year, particularly in speculative securities, have been sufficient in documented cases to support a business determination. The second factor is the period of ownership. Positions held for hours or days rather than months or years indicate a trader's orientation toward capturing short-term price movements rather than an investor's orientation toward long-term capital appreciation. The average holding period of positions inside the TFSA is one of the most important data points the agency examines when reviewing a high balance account. The third factor is the taxpayer's knowledge and experience in the securities market. A taxpayer who has professional training in finance, significant market expertise, or a demonstrated track record of sophisticated investment analysis is more likely to be characterized as carrying on a business because the trading activity is consistent with a professional skill set being commercially deployed. The fourth factor is the time spent managing the account. A taxpayer who dedicates several hours per day to monitoring positions, analyzing securities, executing trades, and reviewing financial data is demonstrating a level of operational engagement more consistent with running a business than maintaining a personal savings account. The fifth factor is the use of margin or borrowed money to finance trading activity. Leverage trading inside a TFSA introduces a profit-seeking commercial orientation that goes substantially beyond the passive wealth accumulation the account was designed to facilitate. The sixth factor is the nature of the securities traded. Speculative penny stocks, options contracts, warrants, junior resource company shares, and other high-risk instruments traded with frequency are more consistent with commercial business activity than diversified index funds. High dividend-paying blue-chip stocks or government bonds held passively over time. No single factor is independently determinative. The CRA considers the totality of the trading history and the circumstances surrounding it, but the combination of multiple factors, particularly high-frequency trading, short holding periods, and demonstrated market expertise, has been consistently sufficient for the agency to sustain a business characterization both through its internal objection process and before the Tax Court of Canada. The legal authority for these assessments is established. The question for any active TFSA trader in 2026 is not whether the CRA has the legal power to reclassify the account's income. It does. The question is whether the trading history inside the specific account provides the factual basis for it to exercise that power successfully. Here is the detail that most TFSA account holders do not understand about how the CRA selects files for this type of review. The financial institutions that administer TFSA accounts, every major bank, credit union, and brokerage operating in Canada, report account balances and contribution and withdrawal information to the Canada Revenue Agency annually. They do not report individual trades, but the agency has the authority under the Income Tax Act to issue a formal requirement to a financial institution to produce complete trading records for a specific account when it has a basis to believe the account may have been operating as a business. When the CRA issues such a requirement, the institution must comply fully and immediately. The account holder is not notified in advance. The trading records, including the date, type, quantity, and price of every transaction executed inside the account, are provided to the agency by the institution without the account holder's knowledge or consent. The first time many TFSA holders learn that their trading history has been reviewed is when the formal notice of assessment arrives. This is the part of the process that makes the TFSA business income assessment categorically different from the principal residence exemption disputes and the renovation receipt audits we discussed in earlier parts of this series. In those cases, the taxpayer typically receives an information request before a formal assessment is issued, yet by giving them an opportunity to provide documentation and make their case before the agency makes its determination. In the TFSA business income context, because TFSAs do not file annual returns, the agency has no obligation to issue a preliminary request before making an assessment. It can review the trading records it obtains from the financial institution, make its determination, and issue a formal notice of assessment directly. The first communication the taxpayer receives is not a request for information. It is a tax bill. There is a further and important trap for Canadians who have made overcontributions to their TFSA, either deliberately or through a misunderstanding of the recontribution rules that govern the account. The contribution limit for 2026 is $7,000. For a Canadian who has been eligible since the account's introduction in 2009 and has never overcontributed and has never withdrawn, the maximum total lifetime contribution room as of 2026 is $109,000. The overcontribution rule imposes a penalty tax of 1% per month on every dollar in the account that exceeds the account holder's available contribution room. The CRA tracks contributions and withdrawals reported by financial institutions annually. If a taxpayer has moved money between multiple TFSA accounts at different institutions, withdrawn and recontributed in the same calendar year in a way that exceeded available room, or transferred assets without properly following the rules governing direct transfers between registered accounts, they may have accumulated an overcontribution that has been accruing monthly penalties without their awareness. The CRA My Account portal displays an estimated contribution room figure, but the data reflected in that display is not updated in real time and may not account for transactions made in recent months. Relying on the portal figure without verifying it against complete records from every financial institution holding a TFSA on your behalf is an error that has cost numerous Canadians thousands of dollars in penalties. For Canadians who are watching this and asking what they can do right now to assess their own exposure, here is the specific and actionable analysis you need to conduct. Pull the complete trading history from every TFSA account you hold at every financial institution. Count the number of transactions you executed in each calendar year. Note the average holding period of your positions in each year. Be honest about how much time you invested in managing the account and what expertise you applied to the trading decisions. Compare that picture against the criteria the CRA uses to characterize business activity. If the picture that emerges looks more like a commercial trading operation than a personal savings account, speak with a tax lawyer who specializes in registered account issues before the CRA contacts you. The voluntary disclosure framework that exists for unreported income does not apply directly to TFSA business income characterization disputes in the same way it applies to other unreported income situations. But proactive legal advice obtained before an audit is initiated can significantly affect the trajectory of any subsequent review and the ultimate financial exposure involved. If you have already received any communication from the CRA about your TFSA trading activity, whether it is a general information request or a formal notice related to your account, do not respond without professional representation. The 90-day objection period that applies to all CRA assessments applies to TFSA business income assessments as well. Missing that window forfeits your right to dispute the assessment in the Tax Court of Canada, regardless of the merits of your position. Non-TFSA business income assessments involve complex legal arguments about the characterization of investment activity under the Income Tax Act that require specialized expertise to navigate effectively. For the Canadians watching this who have held their TFSA as a genuine savings vehicle, who have contributed modest annual amounts, who have bought diversified index funds or dividend-paying stocks and held them through market cycles without actively trading, this investigation carries a clear message for you as well. The account is working exactly as it was designed to work in your case. The CRA's enforcement activity in this area is targeted at trading behavior that goes substantially beyond passive savings. The size of a TFSA balance is not itself a red flag. The behavior that produced the balance is what the agency examines. A taxpayer who held a technology company for 3 years and saw it increase in value tenfold has not carried on a business. Patient investment rewarded by market appreciation is exactly what the account was designed to facilitate and protect. But for the thousands of Canadians who use the TFSA as a tax-free trading platform during the volatile markets of 2020 and 2021, who executed dozens or hundreds of trades annually in speculative securities, who applied professional expertise and substantial time to generating returns that passive investment strategies could not produce. The enforcement activity the CRA has been building to, and the tax bill weighting inside them, is not calculated as a capital gain. It is calculated as if you ran a business, because in the CRA's analysis, you did. In our next investigation, we are going to step back from the individual traps we have been documenting throughout this series and expose the broader infrastructure that connects all of them. We are going to show you how the CRA, the major Canadian banks, FinTrack, and municipal governments are sharing data through frameworks most Canadians have never heard of, and how that shared data creates a surveillance architecture capable of identifying financial discrepancies that no single institution could detect independently. The picture that emerges when you connect the principal residence audit, the renovation receipt review, the TFSA trading assessment, the Airbnb platform reporting requirement, and the bank's own risk modeling algorithms is not a series of separate enforcement initiatives operating in isolation. It is a single coordinated system, and it is watching every financial decision you make. Subscribe to Canada Property Watch right now and enable your notifications, because that investigation will change how you think about your money, your home, and your relationship with the Canadian financial system from the day you watch it.